Sanju Verma now joins in, CEO of Violet Arc Global Managers. Sanju, hi, good afternoon. Good to have you on the show. What's your call right now? We've seen a big rally, but last few days there's been a bit of volatility that's come back to the market. Do you think most of the pre-budget rally is done, or would you expect one more rally going into the budget?
I think, Anuj, while most people did not anticipate a rate cut today, which would have given legs to the rally that we've seen in the last month or so, I had not entirely given up on the hope of being surprised yet again post that out-of-the-box surprise on Jan 15th. My sense is that it's difficult to say whether we will have a pre or a post-budget rally, but the fact of the matter is that, whether the Nifty will go to 10,000, 11,000 or 12,000, your guess is as good as mine. The way I would approach this is that going forward, there is going to be a successive rate cycle reduction. My personal sense is, if you just go by what the RBI governor has said, that the real interest rates need to be in the region of 1.5 to 2%, given that the current repo rate is 7 3/4, and the last printed CPI inflation number came in at 5%. It shows that rates need to go down at least by 75 basis points if we have to achieve a real interest rate target of 2%. Rates need to go down by 125 basis points if we have to achieve a real interest rate target of 1.5%. So my sense is, if you're not entirely optimistic, but you just take Raghuram Rajan's words as a given, even then a 75 to 125 basis point rate cut, is in the offing. Whether it will happen, successively, consecutively, that is the big million-dollar question. My personal sense is that any rate cycle reduction to be effective and for monetary transmission to be effective has to be front-loaded. So I was a tad disappointed, but given that rates will come down, the equity risk premium moves up, the earnings yield moves up, and every sustainable structural bull rally in India, even the one that we saw between 2003 and 2008, if there was one thing that pushed equities and sustained them for 3 to 4 long years in the 20 to 25 times odd P multiple zone, it was the fact that the earnings yield was positive. Today the earnings yield on 1 year forward, a P is something like 6.5% to 7%. So if rates come down, after a long time, perhaps after 3 to 4 years, we will have a scenario where the earnings yield is positive, purely driven by the fact that bond yields have come down. So I think structurally there's a lot going for us, and I would very keenly await not just the budget, but more importantly the CSO estimates which come in on the 9th of this month, and of course the inflation data that comes in the later half of next week. My personal sense is that CPI inflation will continue to be sticky in the region of 5 to 5.2%. So that I think is very reassuring, and don't forget that even the core WPI that stands at just about 1.45%, which I think is a huge positive. So my personal sense is that there is a lot going for us. Most importantly, I think the big thing that no one is talking about is the fact that now, after the data that emerged from the US in the last 24 hours, it is said that US Fed will hike rates now only in calendar year 2016. It will not happen this year because for the first time, the ISM factory gauge in the US, which is a gauge of their manufacturing activity, that actually plummeted to just about 53.5 for the month of June from somewhere like 55 in December. So that's a steep fall, and even the consumer spending data, consumer spending was down 0.3% in December from a 0.5% increase in November, which tells you that the extra savings in the hands of US consumers thanks to lower gasoline prices is not finding its way into the retail markets. People are willing to save more rather than spend more, and that is the reason that even the US savings rate has gone up to 4.9%, the highest it has ever been as a percentage of GDP in the last in the last 10 or 15 years. So I think, given the fact that the Fed is not likely to raise rates in calendar year 2015, Even if it does, it will not happen before September 2015. I think that is the biggest positive. I'm not even so much excited by this, $1.3 trillion ECB buyback. But most importantly, the fact that the data emanating from the Fed is very conflicting. Don't forget that the US fourth quarter GDP came in at just about 2.6%, well below the 5% that they clocked in quarter 3. It just tells you that the green shoots in the US have not entirely emerged, and there are still a lot of conflicting signals which suggest that even in the US there is a lot of slack. There are disinflationary signals, and I think, given that most of us have been saying we are coupled to the US in many ways, if indeed that is true and if indeed that is what you believe in, then I think a dovish US Fed, of course the fact that we are in for a rate cycle reduction trajectory, all this put together in perspective suggests that putting a target to the Nifty will be difficult. But if you're assuming a target multiple of 15 times 3 years hence, and you're assuming that the earnings growth will compound at 13 to 15% on an average for the next 3 years.
I'm sorry to interrupt you. I just need to go across to Sanju. Sanju, do you track this one, TVS Motor, and any thoughts on how to approach the stock now?
Sonia, I think, I would not like to comment on TVS specifically at this point in time because I have yet to look at the numbers in greater detail. But that said, I think I have on your channel a couple of times reinforced that my top pick, even when Maruti was trading at 2,000, I said, we shouldn't be surprised if we see this going up to 5,000 odd over the next 1 or 2 years. And I still maintain, this sounds very cliched because now everybody has a buy on the stock. But my personal sense is if Maruti were to go to 5,000, and you're talking of an EPS of something like 235 or 240 rupees for FY17, then the stock would be still available to you at just about 21 times, which is higher than its average P multiple of 16 times for the last 10 years. But don't forget that, in the December quarter, Maruti has reported the highest EBITDA ever at 1,600 crores. And, this is one company where there's still a margin expansion story. Margins are slated to go up by 300 basis points from the current 12.7 to 15.7 going forward. So I think it's a classic combination of earnings profitability seeing a huge uptick, margin expansion, the yen rupee and the yen dollar pair working to Maruti's advantage, and most importantly the fact that the old earlier mean PE of 15 to 16 times is not something that analysts are now reckoning with. It has had a PE expansion, and now people are willing to pay 21 to 22 times forward for the kind of earnings trajectory and the quality of earnings growth that Maruti is willing to show. So I think one is spoiled for choice within the auto space. I continue to believe that Maruti and Exide again, Exide Industries, I think declared excellent set of numbers, better than market expectations. So these are the two stocks that I would sort of put my neck on the axe for at this point in time.
Sure. Just a couple of more details on TVS Motor. The reason the margins are not as per the street estimates is because the other expenses for them has gone up by almost 15% year on year at 399 crores. And even on the bottom line, the tax expenses are higher this time at 33.5 crores versus 24.36 crores. So all of that really has marred the growth as far as margins and profitability is concerned.
All right, so that's on TVS Motor, still down, it's up about 1/3%. But Sanju, let's talk about the policy today. And in general, your call on the banking space, because that clearly has been the leader. But, we've started to see really bad numbers now from PSU banks. We've seen Bank of Baroda disappoint. Now we've seen Punjab National Bank come out with a bit of a shocker of a number. Even private banks are selling off today. How would you approach banking now?
Anuj, I was clearly disappointed by the policy. As I said, there should have been a 50 basis point rate cut on Jan 15th alone once the rate cut cycle was, decided upon. So I personally feel that there were a lot of contradictions, in what the RBI governor said. If he claims that monetary transmission takes time and, has an impact only 2 quarters or 3 quarters down the line, then I think, any textbook banker also knows, any textbook economist also knows that, loans on the asset side tend to get repriced much faster than deposits on the, liability side. No wonder banks have been cutting deposit rates at a faster pace than they have been cutting the base rates. Point number one. Point number two, going back to the policy, last time in Jan, he clearly said that oil, food, vegetable prices, fiscal consolidation and its quality, and also international events is something he will clearly watch for. And while not much may have taken place domestically with respect to data points between Jan 15th and Feb 3rd, clearly on the international front, we have been deluged with data. In fact, there's a problem of plenty. Even a country, somebody like Russia, which is grappling with, a ruble crisis, Russia chose to reduce rates by 200 basis points from 17% to 15% on Jan 30th. From Sweden, Norway, Denmark, Singapore to, what have you, everyone has been on an easing cycle. And the one big lesson internationally is that austerity is a dirty word. It's not just about Syriza, but the fact that even countries like Spain and Italy are increasingly moving to the left. I think if you take all this data and juxtapose it against what we have done, clearly I feel that there is a lot left to be desired. The problem as I see it is that the RBI governor has been consistently trying to control both inflation and exchange rate. And no central governor, no matter how good or bad he is, can ever control both. You can either control exchange rates or you can control inflation. So if the RBI governor does not want to allow the rupee to appreciate any further, given that we've appreciated 2% in this calendar year alone, then he will have to allow inflation to increase. If he wants inflation to be sticky at the 5 to 6% band, then he will have to allow, the exchange rate to appreciate. Something has to give in. You cannot control both. My personal sense is that given, Rajan's obsession with wanting to control inflation, eventually the exchange rate will rise. I am not from that school of thought which believes that, as per REER, the rupee is overvalued. REER as a concept is passé now because central banks intervene aggressively, and, even countries which say they are capital account convertible actually have to do with managed float. So given that, my personal sense is you will have a scenario where inflation will be sticky, the CPI between 5 to 5.5%. The rupee will appreciate vis-a-vis the dollar. Don't forget that, the RBI has bought close to $24 billion in the last 8 to 9 months. Through direct market intervention. We have a balance of payment surplus of the last 2 preceding quarters to the tune of $19 to $20 billion. And most importantly, through subsidized dollar swaps, NRIs, fund flows from NRIs have been mobilized to the tune of $35 billion. So in all, we are well cushioned to the tune of an additional $70 to $75 billion. And if things stand as they are, our import cover will go up to 17 months, 2 years hence. So my personal sense is if you take all this account, that is one of the reasons. Because of a stable currency, I believe that, the dollar returns to FIs will become very attractive, and that is one of the other reasons why the markets will do exceedingly well. Now coming back to banks, I think the governor said that the days of regulatory forbearance are over. That said, precious little has been done. Anuj, I think the problem that you see today in the banking space has to do with the fact that from June 5, 2013, the restructuring provisions went up from 2.75% on new loans to 5%. And I think the impact of all that is being felt now. How do you otherwise suddenly explain that, Bank of Baroda and PNB have suddenly seen an 18% sequential jump in, net NPAs? How do you explain the fact that, the NII growth has been virtually zilch and negative for an IDFC, only a measly 7.5%, for Bank of Baroda. More importantly, I'm not looking at the gross NPA or net NPA numbers. If you just look at the slippages tell you the story of what lies ahead. The slippages for an ICICI bank, stood at something like 2,300 crores. The slippages of Bank of Baroda stood at 3,000 crores. And from the restructured pipeline, 5,000 crores actually turned into an NPA. This is for Bank of Baroda. For ICICI Bank, from the restructured portfolio, 776 crores actually turned bad and, became SAR. So either banks are not able to estimate the credibility of the restructured pipeline, or things are going from bad to worse, and because of the steep restructuring provisions which came into effect in June 2013, the impact of that is being felt now. So I think the government, including the RBI, will have to give more teeth to the SARFAESI Act, the Debt Recovery Tribunal legislation, that needs to be reworked, and the governor has done nothing on that front. So I think to say that the government has to improve the quality of fiscal consolidation, but banks will continue to do what they are doing without any changes in terms of, the policy environment becoming more facilitative, I think it doesn't work that way. So I think, we need to see more of a facilitative environment from the regulator's end before we see the banking sector actually improving its overall, health. And I think people who say, oh, why should banks not reduce their base rate because their cost of funds is just, the cost of funds of an ICICI bank is 6.16%. The cost of fund for a PNB or a Bank of Baroda is barely 5.8 or 6%. Don't forget, this is just a nominal cost of funds. But, if you add to that the cost of carrying that large, impaired, stressed book on their portfolio, if you add that to it, you will add about 75 to 100 basis points to the 6%, which means that the effective cost of funds for an Indian bank today is not 6.5, but anywhere between 7.5 to 8%.
Right.
The rule of thumb is every 50 basis point increase in NPA, it reduces your margins by 75 to 100 basis points going forward. And we are seeing that happening. To cut a long story short, I have always maintained I like SBI. And I still maintain that because I think cash is king. They're sitting on more than 60 to 70,000 crores worth of cash. And their international loan book is doing very well. Last quarter, that grew by 20%. That accounts for 20% of their overall loan portfolio. So while the domestic side of the business is sluggish like it has been for any other bank, I think SBI, given the fact that it is a leader in the space and the delta it enjoys as and when the economy turns around, this will be the first one to show signs of, sustained recovery. I would still stick my neck out for SBI and perhaps Kotak ING, followed by, Axis Bank in that order. That would be the pecking order.
All right, Sanju, we leave it at that. Thank you for joining us. And